Silver just crashed 17%. Let me repeat that number because it needs to sink in. A single-day crash of 17%. During Asian trading, silver plunged all the way down to $73 an ounce before trimming losses to about 11% by mid-morning. In Europe, that today rebound that made everyone think the worst was over has now been completely wiped out. Our current price is down more than one-third from last week's historical high of over $120. Gold fell 3.5% in volatile trading, and copper has dropped below $13,000 per ton. The entire precious metals sector is under massive pressure. What I am seeing in the data right now is something every investor must understand before the next trading session opens. Now, let me break down exactly what happened and why it's so important. Go ahead and leave a comment right now. What country and city are you watching from? I want to see how global this community really is. Also, tell me what you plan to do with your silver positions. Are you holding, buying the dip, selling, or did you get stopped out? I want to hear your real stories. Let me know in the comments. Now, let me connect today's events with everything we've been tracking. Last month, silver broke through $120 in a record-breaking rally that looked unstoppable. Premiums in the Shanghai market were once 40% higher than COMEX prices. Dealers were struggling to get their hands on physical metal. The momentum seemed unbreakable. Then, last Friday, silver suffered its largest single-day drop ever, the biggest one-day crash in the history of the silver market. Gold also hit its steepest decline since 2013. That was supposed to be the final capitulation sell-off. The two-day rebound that followed was meant to signal that the bottom was in, but that wasn't the case. This 17% plunge tells us the selling isn't over. The floor hasn't been found, and the volatility is far from finished. Let me read a quote from Saxo Bank analysts because I think it perfectly captures where we are. They stated that, after failing to break the $90.50 resistance level, heavy selling emerged in the Chinese futures market and on the CME until the market plummet improves through lower volatility and better liquidity. Silver is likely to continue trading violently in both directions. Those were the exact words, trading violently in both directions. This isn't language analysts use lightly. It's a warning that we are in a regime where standard trading rules no longer apply. Moves that used to take weeks are now happening in hours. Volatility itself is generating even more volatility. Here is what triggered today's crash. According to the data, silver tried to recover after last Friday's disaster. It bounced for 2 days. Traders thought the worst might be behind us, but as the price neared the $90.50 level, it hit a wall of resistance. Sellers overwhelmed the buyers. Once that resistance held, algorithmic selling kicked in. The momentum flipped, and we saw another cascade of price drops, another wave of forced liquidations, and another 17% loss day. Goldman Sachs released an analysis report that I believe every silver investor should study carefully. They warn that extremely low inventories have created squeeze-like conditions. What does that mean? It means when investor demand shows up, it quickly soaks up available metal and causes prices to spike. But when supply pressure eases or selling kicks in, prices reverse just as violently. It's a double-edged sword. The same conditions that allowed silver to rally to $120 are the exact same condition causing it to crash to $73. Low inventory magnifies moves in both directions. There's no buffer, no cushion. Every buyer and seller has an outsized impact on the price because the market lacks the depth to absorb these flows. Now, there's one thing I think is being majorly underreported. The turmoil in silver has made trading much harder for the banks that dominate London's over-the-counter OTC spot market. The leading banks in the London OTC market are finding that the risk of holding either long or short positions even for a short time is becoming too high. These banks are the market makers. They are the institutions that provide liquidity and allow the market to function. And right now, they are backing away because the volatility is too extreme for them to manage. What happens when market makers back away? Liquidity dries up, and when liquidity dries up, volatility increases even further. It's a self-reinforcing loop. Volatility causes banks to reduce their exposure. Reduced exposure leads to less liquidity. Less liquidity causes more volatility. It goes round and round. This is why Saxo Bank said silver will continue to trade violently in both directions. The market structure itself is broken right now. It will take time for things to return to normal. Until then, be ready for the unexpected. There's another factor not getting enough attention. Traders are reporting that higher prices have strained the credit limits allocated to precious metals trading desks. In plain English, what does this mean? Banks have credit limits. They assign a certain amount of capital to their precious metals operations. When prices are higher and volatility is up, every position requires more capital to maintain more margin, more collateral, more of a risk buffer. If the credit limit stays the same, but the capital needed per trade goes up, you can do fewer trades. You provide less liquidity, you pull back from the market. That is exactly what's happening. Right now, credit constraints are limiting the bank's ability to provide liquidity. That drop in liquidity is fueling further volatility and magnifying the impact of derivatives trading on prices. Right now, it is the tail wagging the dog. The derivatives market is leading the spot market instead of the other way around. This isn't healthy or sustainable, but it's our current reality. Now let me explain the macro background that triggered this total collapse. It's true that precious metals have broken records over the past year. This rally was driven by central bank buying, strong ETF inflows, speculative momentum especially from China geopolitical unrest, and concerns over the independence of the U.S. central bank. Investors ditched sovereign bonds and currencies in favor of hard assets. That logic worked perfectly through January. But then President Trump nominated Kevin Warsh as the Fed chair. The market views Warsh as more hawkish. This nomination triggered a dollar rebound. The U.S. dollar index, which tracks the greenback against a basket of major currencies, began to climb. When the dollar rises, dollar-denominated commodities like silver become more expensive for international buyers. That's basic mechanics. All else being equal, a stronger dollar means weaker commodity prices. The dollar's rebound sparked widespread profit-taking. Investors who had built up huge positions through January started to exit. As they left, it triggered a chain reaction. Investors had established massive positions in precious metals using leveraged ETF products and heavy amounts of call options. All that exposure amplified the move on the way up, and it's amplifying the crash even more on the way down. When prices started falling during Asian trading hours last Friday, it sparked a sell-off that lasted into the start of this week. The selling has left the market exceptionally volatile. Despite the two-day rebound, the selling pressure hasn't been exhausted. This 17% crash proves the capitulation isn't over yet. Now, let me start with the bearish case, because if you only listen to bullish analysis, you aren't getting the full picture. The bear case is straightforward and powerful. Silver is down over 1/3 from its historical high last week. This isn't a normal correction. It's a crash, and crashes usually have follow-through. The rebound failed. Silver hit resistance at $90.50 and was rejected hard. Failed bounces often lead to lower lows. The current price action suggests we haven't hit the bottom yet. The CME Group raised margin requirements. This move increases the cost of holding positions, which usually weighs on prices and trading activity. Anyone still holding leveraged long positions is facing higher maintenance costs, and many can't afford it. They will be forced to liquidate. More forced liquidations mean more selling pressure. The dollar is strengthening. The dollar index rose 0.3% to 97.89. A stronger dollar is a headwind for precious metals. If the dollar continues to rise based on expectations of hawkish Fed policy under Warsh, that headwind will get even worse. Liquidity has collapsed, and banks are quitting market making. Credit limits are restricting trading desk activity. When liquidity is low, prices can overshoot in both directions. But in a down market with forced sellers, low liquidity means faster and deeper declines. The extremely low inventory that Goldman Sachs warned about is causing a squeeze effect in both directions. The same mechanism that drove prices up is now driving them down. There is no floor because there is no depth. Saxo Bank stated clearly that silver will continue to trade violently in both directions. These professional analysts who do this for a living are telling you that more volatility is coming. This isn't a prediction of high prices. It's a warning of ongoing chaos. The speculative excess that drove the rally is being washed out. Leveraged ETF positions are being liquidated, and call option positions are being closed or becoming worthless. The fuel that drove the rally has run out. Without that fuel, where does the buying come from at these price levels? Industrial demand might be weakening. Earlier reports showed that industrial buyers included solar panel manufacturers in China. We're looking for silver alternatives when prices were high. If industrial demand softens, a key pillar of the fundamental bull case is shaken. That is the bearish case. The continuous sell-off triggered by margin hikes and liquidity exhaustion is no longer just a matter of price movement. It is a mechanical stampede caused by a lack of market liquidity. In such extreme and violent volatility, the core test is how we maintain our risk bottom line amidst rule changes and data shocks, avoiding being forced out before the market truly finds its floor. Therefore, we have internally compiled a silver flash crash tactical pack to help us maintain rational decision-making in the upcoming high volatility cycle. I have placed this manual in the comments section. Click to claim it. It's serious, data-driven, and explains why we saw a 17% crash right after a 30% drop. This isn't just noise. It's deeply rooted in what's actually happening in the market. Now, let me give you the bullish case, because the bears aren't telling the whole story either. This crash was triggered by forced liquidations, not a change in fundamentals. Goldman Sachs confirmed this in their analysis. As prices fell, dealer hedging flipped from buying into strength to selling into weakness. Stop losses were triggered, and losses poured out like a waterfall. This is mechanical selling. It's not that investors analyzed the fundamentals and decided silver is worthless. It's that leveraged players were kicked out of the market regardless of their long-term views. When forced selling runs its course, prices often snap back violently. Silver is now trading at more than a 35% discount from its recent high. Every major commodity bull market has violent corrections along the way. 30% or 40% drops happen often. They wash out the weak hands and transfer assets from speculators to long-term accumulators. Then, the bull market continues. This crash doesn't prove the bull market is over. It proves the bull market ran too fast and needed a correction. The fundamental logic for silver remains intact. Solar demand hasn't disappeared. The electrification of everything isn't slowing down. And the supply deficit hasn't been solved. The long-term structural arguments haven't changed. What changed is that the speculative excess got cleaned out. It's painful, but it's healthy. Even though paper prices crashed, global physical demand remains strong. Earlier reports showed that dealers are still having trouble getting metal, and premiums in key markets remain high. If physical buyers are still entering the market at these prices, it creates a floor that paper selling cannot permanently break. Central banks continue to add gold at record speeds, and that trend hasn't reversed. The de-dollarization thesis hasn't been proven wrong. The reasons investors turned to precious metals over the past year still exist: geopolitical uncertainty and fears of currency debasement. Those drivers haven't gone anywhere. The dollar's strength might be temporary. The Warsh nomination triggered the move, but he hasn't been officially appointed yet. His actual policy stance might be more nuanced than the market's knee-jerk reaction suggests. If the dollar's rally stalls or reverses, a major headwind for precious metals disappears. Goldman Sachs noted that low inventory creates squeeze conditions. Yes, it hurt silver this week, but it can work in the opposite direction just as fast. When selling is exhausted and buyers return, the same low inventory that amplified the crash will amplify the recovery. The rebound could be just as fierce as the sell-off. I want you all to think about one question. If you were bullish on silver at $120, are you more or less bullish at $73? The fundamental story hasn't changed. Only the price has, and now it's 35% cheaper. If you liked something at full price, you should love it at a discount. Unless your logic has fundamentally shifted, a price drop represents an opportunity, not a danger. Now, let me talk about what to watch for in the next 24 to 48 hours. Because the next few sessions will tell us if the crash is over or if there is more pain coming. Watch the $73 level. That was today's intraday low. If silver decisively breaks below $73, it opens up room for further decline, with the next major support in the $60 to $65 range. Breaking $73 would signal the selling isn't over. Watch for the $90.50 level in any bounce. That's where the rebound failed today. There was heavy selling there, and it has now become a resistance level. For any real recovery, silver needs to reclaim that spot. Until it does, any bounce is questionable. Watch the dollar index. If the dollar keeps strengthening, it will continue to weigh down all commodities. If the dollar stalls or pulls back, a major obstacle is removed. The dollar's direction over the next few days might be more important than what is happening with silver itself. Watch what gold does. Silver is more volatile than gold, but it usually follows gold's direction in the long run. If gold stabilizes and finds support, it's good for silver. If gold keeps dropping, silver will likely fall much harder. Gold being down 3.5% today is worrying, but not yet a catastrophe. Let's see if it can find a floor. Watch for any statements from major banks or institutions regarding their precious metals trading. If banks are struggling with liquidity and credit limits, we might hear about it. Any signal that institutions are further reducing their exposure is bearish. Any sign that things are normalizing is bullish. Watch the CME margin announcements. If the CME raises margins again, it will force more liquidations. If they keep them the same or lower them, it's a sign they think volatility is peaking and things are stabilizing. Let me share a truth about volatility that many people don't understand. Volatility isn't directional. High volatility doesn't mean prices will go down. It means prices will move more violently, in both directions than usual. The same conditions that create a 17% crash day can create a 17% rally day. When Saxo Bank says silver will be violently bidirectional, they mean expect massive moves both up and down. If you can handle that volatility and your positions are right, there's opportunity. If you can't handle it or your leverage is too high, this environment will destroy you. The key question is whether you can survive the volatility until your logic is proven right. If you hold physical silver, have no leverage, and a time frame of several years, today's price action is interesting but doesn't require action. You aren't selling. You might even be buying. Volatility doesn't threaten your position. But if you're holding leverage positions with stop losses, volatility is your enemy, regardless of whether you're eventually right about the direction. Now let me connect all of this to the bigger picture. The rally in precious metals over the past year happened for real reasons. Central bank buying, investors avoiding bonds and currencies, rising geopolitical risks, and increased concerns over Fed independence. All these factors are still here. The Warsh nomination didn't fix these things, the strong dollar didn't fix them, and the crash in paper prices didn't fix them either. What the crash did was separate the speculators from the investors. Speculators are being washed out, leverage players are being liquidated, and momentum chasers are collapsing. It's painful, but it's a kind of purification. When the speculators leave, the investors remain, and investors buy value right now. Silver is at a 35% discount from its recent high. That looks like value to an investor, even if it looks like danger to a speculator. 3 key takeaways before we finish. First, silver dropped 17%, wiping out a 2-day rebound. We are now down 1/3 from last week's high. Professional analysts believe the selling isn't over. Saxo Bank said clearly that until the market plumbing improves, silver will continue to be violently volatile. Goldman warned that low inventory will amplify moves both ways. The bottom isn't confirmed. More volatility is ahead, so adjust your positions accordingly. Second, the market structure is broken right now. Major banks in London OTC trading find the risk too high. Credit limits are holding back trading desks. Liquidity has vanished, and that lack of liquidity is fueling more volatility. This isn't normal. It's a crisis state. Until liquidity returns and volatility settles, expect the unexpected. Moves that should take weeks are happening in hours. Traditional support and resistance levels are being sliced right through. Standard trading rules are out the window. Third, the fundamental logic for silver hasn't changed. Demand for solar and electrification and the supply deficit are still there. Central banks are still buying gold. The reasons investors turned to precious metals last year haven't disappeared. What changed was that speculative excess got violently corrected. The correction might not be over, but it hasn't disproven the long-term case. For long-term investors, this is opportunity. For short-term traders, this is danger. Know your role and build your positions wisely. I'll leave you with one last thought. In the short term, markets are irrational. They are driven by fear, greed, leverage, and forced liquidations. What we're seeing right now is an extreme example of those four factors combined. Dropping from 120 to 73 in a few days isn't rational price discovery. It's a mechanical dismantling of leveraged speculative positions in a market with no liquidity. Eventually, the mechanical selling will run out. Eventually, liquidity will return. Eventually, prices will reflect fundamentals instead of forced flows. The question is whether you can hold on until then. If your positions are right, you have no leverage, and you have a long-term view, you can wait. If you're over-leveraged and have a short-term view, you probably can't. Do your own due diligence, understand the risks, and take responsibility for your decisions. Have a clear plan and know your time frame. Are you trading the hourly chart or investing based on a yearly logic? Your answer determines how you should interpret everything happening right now. Plan and position yourself accordingly. The current market is undergoing a deep logical shift, and market behavior has evolved from simple price fluctuations into an extreme test of liquidity boundaries and structural failure. This high-frequency and violent bidirectional movement is actually a process of the market seeking a new equilibrium under extreme pressure, with a level of complexity that has exceeded conventional technical boundaries. To that end, we have internally compiled a silver flash crash tactical pack to help us maintain a calm observational perspective during this turmoil caused by structural imbalance. I have placed this manual in the comments section. Click to claim it.